Welcome to vTalkInsight, Market Drivers Daily for December 10th, 2025. Geopolitics, artificial intelligence, and growth are all moving at once today, and markets are trying to decide whether this mix extends a late-cycle rally or narrows the runway. Let's start with how rising geopolitical tension is being translated directly into capital flows, sector performance, and trade policy risk. Across Europe, security policy is now a major macro driver rather than background noise. Germany is preparing record defense procurement, with roughly 52 billion euros in contracts on the table, far above its entire pre-Ukraine military budget. That is feeding a powerful rally in European defense names, from Rheinmetall to other regional peers, and signaling a multi-year demand pipeline for equipment, vehicles, air defense, and surveillance. This kind of structural fiscal expansion does not just support the defense sector, it also ripples into industrials, capital goods, and domestic growth expectations. Alongside rearmament, Europe is edging toward using frozen Russian assets to fund Ukraine, with figures around 90 billion euros being discussed. Markets are watching Belgium, which remains the main holdout, and whose legal concerns need to be resolved within roughly the next couple of weeks for a deal to stick. European officials are working hard to frame this as a one-off, exceptional measure, precisely to reassure investors that euro area safe haven status and property rights are not being opened up more broadly. The key takeaway is that politics and capital flows are colliding, but policymakers know they must protect the euro's institutional credibility even as they push unprecedented measures. On the U.S.-China axis, the decision to allow NVIDIA and other U.S. chipmakers to sell H200 AI processors into China, subject to a 25% surcharge, marks a notable shift. On paper, the revenue opportunity is large, with estimates of tens of billions of dollars if Chinese hyperscalers can buy at scale, and related names like AMD and Intel have already seen sentiment support. However, the arrangement is complex. Washington is effectively taxing exports. Chinese regulators are reportedly tightening import permits, and NVIDIA itself is keeping base case expectations for China revenues extremely conservative. Investors are treating any realized sales as upside optionality rather than a core part of the earnings framework, which helps contain both euphoria and downside if approvals disappoint. Broader trade tensions continue to simmer in the background. The U.S. is simultaneously channeling $12 billion of tariff revenue back to farmers hurt by earlier trade rounds and floating new levies on goods from Mexico, Canada, and India. At the same time, U.S. import sourcing has shifted away from China towards Southeast Asia, even as China has grown exports strongly to Europe, Africa, and Asia, and stepped up investment in high-tech sectors abroad. This creates a world where headline U.S.-China flows shrink, but overall reliance on Asia and exposure to Chinese-backed competitors remain, complicating the idea of simple decoupling. These moves also highlight concerns about the consistency of U.S. policy. Allowing exports of advanced AI chips that are only slightly behind the frontier, while citing national security to restrict domestic AI regulation at the state level, sends a mixed message to allies and rivals. Perceptions that trade, fiscal, and security goals are being balanced on the fly can weaken trust in U.S. leadership and increase the geopolitical risk premium demanded by both foreign governments and private capital. For markets, that may show up as higher required returns on U.S. assets at the margin, especially when combined with large deficits and heavy issuance. Looking ahead, several geopolitical signposts matter for portfolios. In Europe, final approval of Germany's defense package and any breakthrough on Russian assets will influence defense equities, sovereign spreads, and the perception of euro area cohesion. In Asia, Chinese decisions on actual purchase permits for H200 chips and any further U.S. legislative attempts to tighten export controls will shape the earnings path and volatility for global semiconductors. And in trade, the U.S. Supreme Court ruling on tariff authority, plus any new tariff threats on agriculture or industrial goods, could quickly feed into currencies, commodities, and supply chain-sensitive sectors. All of this sets the stage for the next driver: how AI itself is evolving from a single sector story into a broad, economy-wide force. Artificial intelligence remains at the heart of the macro and market narrative, but it is no longer just a single stock or hardware trade. The approval for NVIDIA's H200 chip exports to China, even with a 25% surcharge and an 18-month technology gap versus its latest Blackwell line, shows how AI now sits at the intersection of national security, industrial policy, and corporate earnings. At the same time, Chinese champions like Huawei are demonstrating that they can match high-end server performance through large-scale aggregation, underlining that the competitive landscape is getting more complex. Investors are therefore less focused on absolute chip performance and more on ecosystem control, software lock-in, and where the long-term profit pools will lie. Under the surface, an enormous build out of AI infrastructure is underway. Brookfield and Qatar Investment Authority are backing a $20 billion push into AI data center assets, while firms like Boom Supersonic are repurposing their turbine technology to supply several gigawatts of power to hyperscalers by the end of the decade. Estimates point to a 47-gigawatt power shortfall in the U.S. by 2028, driven heavily by AI demand, prompting creative solutions such as gas turbines and even reusing old Bitcoin mining sites. This energy squeeze is already showing up in higher electricity bills in data center-heavy regions, which could influence both utility earnings and consumer sentiment. On the user side, enterprise adoption is accelerating and broadening. Forecasts suggest around 80% of companies may have at least one AI product live by the end of 2025, and we're seeing that in examples like Walmart's AI native shopping platform and inventory automation, and Accenture's large-scale training of its 750,000-person workforce. Anthropic's enterprise revenue jumping from $1 to $10 billion annualized in a year, driven largely by coding and productivity applications, shows how quickly spend can scale when use cases are clear. As a result, market leadership is already rotating away from a narrow group of AI hardware names toward data infrastructure, utilities, financials, healthcare, and software platforms that embed AI into everyday operations. Against this boom, the social and regulatory backdrop is turning more complicated. Surveys show business leaders and investors broadly optimistic on AI, but the public is far more skeptical, especially around consumer protections and misinformation, and many younger white-collar workers worry about job security. Paradoxically, employees who already use AI in their roles report stronger confidence in their career prospects, and there is wide agreement across companies and the public that large investments in upskilling and training are essential. Regulators are also stepping in. The European Union is probing Google's AI practices and antitrust behavior, and more than 80% of executives expect government oversight, even as they debate how to avoid stifling innovation. From a macro perspective, AI is increasingly embedded in forecasts and asset allocation debates. Productivity gains from AI are expected to lower costs and support strong GDP growth into 2026, even if unemployment edges higher and policy rates fall, raising the prospect of a kind of jobless recovery. Bond specialists see this combination of above-trend growth and still high all-in yields as supportive for fixed income, while equity strategists highlight that earnings growth, especially in technology, remains a key driver of index performance. At the same time, private markets are projected to grow from about $20 trillion to $30 trillion by 2026, with AI infrastructure and software a central theme, and a robust pipeline of AI-related IPOs is anticipated for 2026. There is a growing counter-narrative that tempers the bullish tone. Retail investors increasingly acknowledge the possibility of bubbles in both AI and crypto assets, and examples like CoreWeave's large debt issuance, alongside equity weakness, highlight dilution and funding risks tied to aggressive AI build-outs. Power constraints, rising electricity costs, regulatory uncertainty, and geopolitical friction over chip exports all cap how fast AI can scale in practice. Key watch points now include Chinese approval for actual H200 purchases, the outcome of EU actions against major platforms, concrete productivity evidence in upcoming earnings, and whether the expected broadening of AI-driven gains into sectors like healthcare, utilities, and financials really takes hold. Those dynamics feed directly into the broader growth and late cycle story. The growth backdrop into 2026 still looks constructive, even as markets acknowledge a thinner margin for error. U.S. labor data remain resilient. Job openings for October came in around 7.6 million versus expectations near 7.1 million, and recent readings on JOLTS, ADP, small business surveys, and jobless claims all point to improving employment conditions. November data show small firms adding more jobs than medium and large companies, and small business sentiment has reached a 3-month high, with a notable share of owners expecting stronger sales in the coming quarter. This combination suggests that the backbone of the economy is still in expansion mode rather than sliding toward recession. Consumer activity is reinforcing that picture. Black Friday and Cyber Monday sales were strong. Holiday spending is projected to approach $1 trillion with average family outlays at multi-decade highs, and mall foot traffic has climbed between 6 and 10% year-on-year. Travel demand is robust, with U.S. passenger screenings hitting record levels, supporting airlines, cruise lines, and hotels, while consumer-facing equities from dollar stores to autos have rallied on expectations of steady demand. Reports that wages are now outpacing inflation for many households provide an additional tailwind, even as some metrics, like AI-driven bargain hunting, show shoppers becoming more price-sensitive and sophisticated. Corporate earnings are backing up the macro data. Median S&P 500 earnings growth is running near 10%, the strongest pace in roughly 4 years, and stock-specific stories from Carvana's turnaround and index inclusion to serve as Titan's 25% revenue growth with 80% gross margins underline vigorous profit momentum. In animal health, Elanco and its peers point to steady mid-single-digit revenue growth, faster EBITDA and EPS expansion, and a $20 billion industry growth runway over the next decade, helped by trends like pet humanization. Other areas, such as GE Vernova, lifting its revenue and margin targets on rising gas power demand, and a still healthy advertising market, round out a picture of broadening earnings support beyond a narrow AI cohort. Policy and global positioning are adding further layers to the growth story. Strategists anticipate a global cyclical upswing in 2026, underpinned by widespread rate cuts and ongoing expansion, while fixed income remains attractive thanks to high starting yields and resilient corporate balance sheets. Emerging market equities, especially India, are favored by some houses due to strong policy frameworks, robust growth, and valuation discounts, and private markets are projected to expand from $20 to $30 trillion over the next couple of years. Together with U.S. fiscal support and European spending on defense and infrastructure, this reinforces an investment-led expansion narrative, even as it deepens reliance on capital markets and policy credibility. There are, however, clear fault lines beneath the surface. Trade tensions remain a persistent drag, with tariffs depressing U.S. exports, especially in agriculture, and new threats directed at Mexican goods, Canadian fertilizer, and Indian rice raising the risk of further supply chain disruption and cost pressure for smaller businesses. Bond markets are also flashing a nuanced message, with yields implying strong growth and inflation in the first half of next year, but softer growth and disinflation later on, hinting at a potential downshift, just as valuations, particularly in U.S. equities, are already demanding. Europe adds another complication, as structural headwinds from bureaucracy, lagging productivity, and fragmented capital markets offset some of the cyclical boost from German fiscal expansion and defense orders. Pulling this together, the base case remains one of continued expansion, but more dependent on supportive policy, strong earnings, and stable risk sentiment than earlier in the cycle. Upcoming labor reports, realized holiday sales, and guidance from consumer, travel, and industrial companies will show whether current strength can carry into the second half of next year. At the same time, German contract awards, EU decisions on fiscal measures, central bank communication on the speed and depth of easing, and the execution of reforms in key emerging markets will shape cross-regional performance. For multi-asset investors, that means watching not just the headline growth number, but how it interacts with trade frictions, AI-driven productivity, and the evolving geopolitical landscape we discussed earlier. To sum up, today's drivers point to a late-cycle environment where geopolitics, AI, and growth are tightly intertwined. European defense rearmament and U.S.-China tech frictions are actively reshaping sector risk premia, while AI is broadening from a narrow chip story into a full ecosystem that touches power, regulation, and labor markets. Growth data, earnings, and policy expectations still support a constructive outlook into 2026, but valuations, trade tensions, and policy inconsistency leave less room for error and argue for close attention to dispersion and scenario risk. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.